Australians are obsessed with properties and trusts. People here prefer setting up trusts even more than they do companies. According to the latest data from ATO, there are over 1.4 million trusts compared to around 1.1 million companies. That's a lot of trusts. There are fixed trusts, unit trusts, wholesale unit trusts, discretionary trusts, which family trusts will fall into this category, self-managed super funds and other super funds, public unit trusts, which include those investments that you can find on the stock market like mutual funds and real estate investment trust rates. Discretionary trusts are probably the type of trust that most people will come into contact with. This is one you might heard rich families set up as family trusts. Indeed, in Australia, family trusts are primarily used by the wealthy, with 0.4% of taxpayers accounting for 95% of the income distributed from such trusts. According to the Australian Financial Review, there are about 928,000 family trusts in Australia with assets of more than 2 trillion. So, what is a family trust? A family trust is a discretionary fund that holds valuable family assets and distributes income to its beneficiaries. Imagine a treasure chest that holds your family's prized possessions, from properties to shares, from collectibles to cash. Now, imagine there's a way to manage this chest, deciding how and when to share its treasures with your family. That's the role of a family trust in a nutshell. A typical trust arrangement involves a trust fund and the following parties. It will have a settlor, or occasionally the grantor or founder legally creates the trust by signing the trust deed and feeding in the initial assets of the trust fund, normally $10 to satisfy a legal fiction. And this person is usually an accountant or lawyer, someone outside the family, making sure everything is legit. And you got the trustee, the manager of the trust fund. They make sure the chest is well kept and follows the rules of the trust deed and the law. Whether it's buying property, investing in stocks, or opening bank accounts, the trustees handle this at all. A trustee can be an individual, a group of people, a corporation with a single director, or a corporation with a board of directors. And then you got the beneficiaries are the reasons that the trust exists, and they are the family members, kids, grandkids, sometimes even further down the line who benefit from the trust assets. They are the ones who get the treasures distributed by the trustee. And some trusts also have an appointer, a powerful figure who can hire or fire trustees, ensuring the trust is always in good hands. The beauty of a family trust, it can hold any asset that you can think of, making it a versatile tool for wealth management. Setting one up might cost around $2,500 initially in Australia, with annual maintenance fees in the same ballpark. And depending on where you live in Australia, you might also need to consider stamp duty for the trust deed. Family trusts have its many benefits to be popular. That's why plenty of people choose to set one up. One of the standout advantages of family trusts is their ability to optimize tax outcomes. How? Well, unlike individuals, a family trust itself isn't directly taxed on the income it distributes to its beneficiaries. Therefore, the trustee can distribute income to different beneficiaries, normally different family members, to suit their personal tax rates best. And this process, known as income splitting, can lead to significant tax savings. Let's take the Thompson Family Trust as an example. Imagine Tom, who runs a successful family business, bringing in $300,000 annually, and Tom's wife is taking a career break, looking after 2 children, 19-year-old David and 8-year-old Daisy. Before Tom set up the family trust, he would have to pay about $120,000 tax. After Thompson Family Trust was established, he could place the profits within the family trust. He could distribute the minimum threshold to both his wife and his son, and no distribution to his daughter, as minors under 18 would face penalty tax rates. And the family trust structure would help Thompson family save almost $20,000 in tax. Moreover, when a trust sells assets it has held for over a year, it can qualify for a 50% discount on capital gain taxes. However, it's not all smooth sailing. Any income earned by the trust that isn't distributed by the end of the financial year gets taxed at the highest marginal rate, which encourages timely distributions. Also, while the trust can distribute income, it cannot distribute capital losses. And these losses stay within the trust and must be offset by future gains. Another big reason family trusts are a go-to for many is the solid layer of protection they offer for your assets. Here's the thing, even though beneficiaries might benefit from the trust income, they don't actually own any of the trust assets. And that's the job of the trustee, who could be a company, especially set up for this role. What does it mean for you and your family's wealth? Imagine a scenario where financial trouble hits, be it personal debt, a lawsuit, or even a bankruptcy situation. If your assets were sitting in your own name, you'll be vulnerable, up for grabs by creditors. But if they are nested safely within a family trust, they are out of reach. And this setup provides a fortress for your assets, keeping them separate from your personal financial challenges. And in cases of divorce, the assets in the trust are not automatically split up since they are not considered personal property. And also, family trusts can provide privacy. In today's digital age, privacy, especially when it comes to financial matters, is a rare and highly valued commodity. And this is where family trusts shine. Unlike wills, which become public documents upon death, or companies whose directors and shareholders' details are easily accessible through databases like Asset Connect, the details of a family trust remain under wraps. The terms, beneficiaries, and assets within the trust don't need to be disclosed or made public, even after the settlor passes away. And this privacy extends to the way assets are managed within the trust by pooling investments into one substantial fund rather than having them scattered across multiple smaller entities. A family trust can more effectively pursue long-term investment strategies, and this consolidated approach not only simplifies management, but also has the potential to yield better performance over time. And family trusts are not just about managing your assets now. They are a powerful tool for planning your legacy. They offer a strategic way to ensure your wealth is passed on and used according to your wishes, even long after you're gone. One of the standout features of a family trust is the ability to set specific conditions for asset access. You can dictate how and when beneficiaries receive benefits, offering a level of control and customization that isn't always possible with a will. For instance, you might specify that beneficiaries can only access their inheritance at a certain age or for specific purposes like education or starting a business, and this ensures your vision for your family future is respected and carried out precisely as you intended. Family trust can be a guard against potential future changes in tax law. While Australia abolished death duties in 1979, there's always the possibility, however slight, that such legislation could be reintroduced. A family trust offers a layer of protection against these and other duties, preserving your wealth for future generations without the burden of unforeseen taxes. However, it's important to know that family trusts do come with a built-in expiration date. And most family trusts in Australia are designed to last for 80 years. And this means that typically 2.5 generations after its establishment, the trust will vest and the assets will be distributed among the beneficiaries according to the terms you've set. If you're still watching this video now, you are probably wondering if setting up a family trust is the right move for you. It might sound like something out of a wealthy tycoon's playbook, but in reality, a family trust can be a smart move for a lot of different people. Here's a quick rundown of who might want to think about starting one. Number 1, if you're bringing in a pretty penny and the taxman seems to be your best friend or worst enemy, a family trust could help spread out your income in a way that could save you some money on taxes. It's like splitting a large pizza with your family so everyone gets a slice rather than eating it all yourself and feeling a bit sick afterwards. Number 2, if your investment portfolio is starting to look more like a treasure chest, a family trust can help manage those assets in a smart way, especially when it comes to taxes and protecting your investments from any personal financial hiccups. Number 3, if your family business is booming and you are thinking about the best way to manage and protect all that hard work, a family trust can give you a hand. Number 4, if you are starting something new and exciting with dreams of it turning into a gold mine, a family trust can be a great way to organize your new venture's finances. Protecting your building business and ensuring its benefits can be shared smartly with your loved ones. In simple terms, if you're looking to protect your money, save on taxes, and make sure your loved ones are taken care of, it's worth chatting about family trust. However, entering into a family trust isn't a simple decision. It requires careful thinking and professional advice to benefit the family properly and achieve their long-term goals. My name's Irene. I'll see you next week. Bye.